Joining me right now is independent advisor at Alliance Chief Investment Officer Chris Zaccarelli. Chris, great to see you. Thanks very much for being here. Your reaction to that and this new proposal for new regulations on the major banks?
Yeah, thanks for having me back. I think, these new proposals are going too far. I mean, ultimately, our big banks are very well regulated. There's been plenty of new regulations, new laws targeting them. We have really, really strong banking regulations already. What we probably want to focus on is those parts of the banking system which are not as heavily regulated. And so I think the regulators, again, are fighting the last war, looking at where the problems were in the global financial crisis and potentially in some of the years after that. But ultimately, those regional banks that collapsed, it's been few and far between. It's been interest rate risk. Regulations would have prevented the banking failures that we saw back in early March. What would have prevented them would have been either better management teams that saw the interest rate risk, or better communication between the Federal Reserve, which was raising rates in the first place, and those banks which had had their liability structures upside down.
Yeah.
And ultimately, it's that interest rate risk that bankrupted those banks and created the run on the banks that we saw earlier this spring.
Right, and you also have the risk of a slowing economy for all of these major banks, big portion of their business, consumer lending, mortgages. Take a look at rates this morning. The 10-year Treasury hitting a new low since early September. Now it is sitting at 4.15%. That's up 3.7 basis points this morning. We, of course, have the Federal Reserve monetary policy meeting next week. The central bank expected to have another pause in rates. But the debate is out about what the Fed does in 2024. What are you expecting next week and for 24 in terms of rates?
Yeah, so for next week, the last meeting of the year, we're expecting the Fed to keep rates unchanged. They've really raised rates far enough at this point. Inflation seems to be coming back down. At least the rate of inflation is coming back down. So really the question is, what will happen next year? And so I think a lot of the market is pricing in cuts pretty front-loaded, looking as early as March for them to start cutting rates. And that could be one reason why you're seeing the 2-year go down in yield, seeing the 10-year go down in yield. There's plenty of other factors as well. But ultimately, the market is pricing in cuts really early on. We disagree. We think the Fed will cut rates next year, but we think it'll be more of a backloaded second half part of the year. And we think the Fed will be cutting rates, not necessarily because they're seeing anything with a dramatic response within the stock market or within financial conditions, but more just as long as inflation continues to go lower, they'll cut rates at a slower pace. So we see them cutting rates maybe 2 or 3 times, probably 25 basis points each time, but in the second half of the year, or at least well past March. That's our view for next year.
Well, Mark Tepper, jump in here because we've been talking so much about the fact that if we were to see a lot of rate cuts next year, it's in response to a real slowdown in the economy.
Yeah, and it's surprising. The market continues to grind higher while the number of rate cuts expected next year continue to go up. I mean, right now the Fed Fund futures are expecting 5 cuts next year, which is a heck of a lot. Chris, quick question for you. I'm looking at your stock picks. I see you like JP Morgan and Morgan Stanley, and I'm curious about your outlook for mergers and acquisitions, M&A. M&A this year has been a complete graveyard. There's not really any deals getting done because there has been no visibility of interest rates. However, next year, with more visibility of interest rates, do you think M&A can rebound next year?
Yeah, that's a great question. We do. I mean, I think part of the reason you're seeing such a tough year, obviously 2022, financial markets, both bonds and stocks selling off, difficult environment. This year, to your point, a lot of issues with the Federal Reserve continuing to raise rates and not really understanding what the rate environment is. We do believe things will look better next year for mergers and acquisitions, for investment banking activity in general, as long as the economy continues to stay positive, not roll over into recession. And we are seeing a rolling economy, so that we are seeing an economy that is slowing, so that is a risk. But ultimately, if the rate picture can stay the same or potentially see some rate cuts, you're not having the Fed raising rates, you're having an economic environment which is slowing but still positive and not a recession, we think that could be a good opportunity for mergers and acquisitions. And clearly there's a backlog because there's been so few transactions that have taken place this year.
Yeah.
So we think it could be a very good year next year for all of those reasons.
Yeah, we'll see if all the business that's currently on the shelf comes off the shelf next year. Chris, good to see you this morning. Thank you.